Hello everyone, and welcome to this presentation of the right way to trade tops and bottoms. Welcome, my name is Stephen Primo. I am the president and founder of Specialist Trading, and the webinar which I'm about to present to you is probably one of our most popular and most requested presentations. So we're going to be doing this because a lot of people love the information that we're going to be giving you. I'm going to be actually giving you a great technique for entering in some really nice trending markets, regardless of what direction and regardless of what time frame. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you a lot of performance results using this entry technique, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So as you're taking a moment to view our disclaimer, I'd also like to invite each and every one of you to now join us on Twitter. This is our name right there. As you can see, that's our handle at SPCLSTTRADG. We post a lot of great free information from time to time. In fact, today we also posted and alerted a lot of our followers that we had a sell signal in the E-mini. And at one point today, you had a gain of nearly 10 points in the E-mini. And so we give a lot of free information, not only for the E-mini, but for stocks and for the Forex markets as well. So feel free to follow us on Twitter. Now, before we begin, just a little bit of philosophy about Specialist Trading. We are first and foremost an educational company. I've been trading for 37 years. I started my trading career on the floor of the Pacific Stock Exchange. I was on the floor for 16 years, and 9 of those years I was a specialist. So that's where we get the name Specialist Trading. I traded through just about every market you can think of, straight up, straight down markets. I traded through crashes, through great bull markets, and I've seen and heard just about everything and anything. And the one thing that sticks to mind is that the reason why most traders lose, myself included, because I fell into this category when I first started trading, is because we pretty much give our power away. We want to rely on too many outside sources telling us what to do or what the proper way is to trade. And if that were really true, then everyone would be successful. It's been estimated that over 80% of all traders ultimately fail. So what I've seen in my 37 years is what really gets you to that consistency level is by stripping away most of the things that you've been taught and just sticking to really fundamental, basic information, keeping your trading plan as simple as possible. When I started doing this on the floor, that's when my trading started to become consistent. So this is what I teach and mentor all of my students. We have strategies, we have tips and techniques such as I'm going to share with you today, but our goal is not simply to force feed you these things and tell you when to buy and when to sell. We're more about empowering you with this information so that you can ultimately make your own trading decisions. So we don't want you to simply take a signal because a strategy generated one. We want you to decide whether you want to take the signal off of your own input, whether you want to trade it conservatively, aggressively, whether you want to exit at the first exit point or stay in the trade longer. These things are all part of your discretionary process, which we teach and which we want you to incorporate in your trading. So that's our goal, not simply to trade for you like a lot of other sites do, but educationally we want to teach you how to trade with the specialist edge. In our opinion, this is what's going to get you on that road to consistency. Okay, with that said, now as I stated, we're going to repeat probably one of our most popular presentations. It's what my feeling is the proper way and the right way to trade tops and bottoms. But first and foremost, right off the bat, I just want to tell you that this technique is a great technique. I use this personally, but it's only an entry technique. I know a lot of you will be saying, well, Steve, where do I exit? Where do I place my stop? Where do I enter? Remember, this is just an entry technique. You can design a strategy based off this, or you can incorporate it in a strategy that you're currently using. But please remember that these are just pieces of the puzzle. Remember, this is an educational presentation. We're not giving you a strategy today saying that you buy here, you place your stop here, you exit here. Once again, we don't want to do all the work. We want you to become a part of the process. So feel free to use this entry technique as you see fit. All right, now, let's start off by sharing with you how most people trade tops and bottoms. And I'm saying this from first-hand experience because this is the way I used to trade when I was on the floor. And in order to trade this way, let's first look at stocks and let's see the way I used to trade. Let's look at some older examples. We're going to show you some examples that are roughly about a year old, but they're mainly for educational purposes only. At the end of the presentation, we'll show you examples that happened this past week. All right, this is the way most people will trade tops and bottoms. Okay, what will happen firstly is that they'll have some type of overbought, oversold tool. So as we see here on the bottom, we have an overbought, oversold oscillator. This is just your standard slow stochastic. I haven't altered it or edited it. This is probably on every major charting software, just a slow stochastic. The overbought threshold is usually right here at 80, and the oversold threshold is usually at 20. Right? So most of the time what you're looking for is these indicators to get into the overbought territory. And once these lines cross, that's your signal to go short or to exit. And when you get in the oversold territory here, once your lines cross, that's your signal to enter. So if we see here, these are the 2 points in which this first started at in this example, and this worked fantastic. The 2 lines crossed here in the so-called oversold area, and we had a really nice rally in Apple. And then when we got into the overbought area, the lines crossed, giving you or generating a sell or shorting signal, and look what happened. So at this point, you are probably excited trading this way. I know I was when I first started trading on the floor, thinking that this is going to be easy. I'm just going to follow this indicator, and I'll pick every overbought, oversold situation there is. So you've had 2 really good winning trades, and then you get another signal here. The lines cross to go long on Apple again. So you purchase Apple, you cover your short, and Apple doesn't go up right off the bat, but ultimately it starts to go up. So you're waiting for it to get into the overbought territory again. And as you're waiting, it goes even lower. But that's okay. You had some really nice gains here with these first 2 trades. So you decide to double up and buy some more because we're right back down in the oversold territory. So you buy some more, and guess what? It goes even lower and lower. And pretty soon you've not only lost on the last couple of trades, but you've given everything back you made on the original 2 winning trades, okay? How about the E-mini S&P? The same phenomena works in the markets as well on the futures markets. If we look at a daily chart, an older chart of the E-mini S&P, we see here that we have the same indicator plotted, the slow stochastic, and it doesn't have to be the slow stochastic. It could be any overbought, oversold tool. It could be the fast stochastic. It could be a momentum tool, an RSI, whatever you're looking at that tells you that something is overbought or oversold. It can even be a fundamental tool. So we're just taking this as an example or a generic example. So as you see here, the same situation appeared. We were in the overbought territory, the so-called overbought, and the E-mini falls out about 20 points, about $1,000 per contract. And then it crosses over, it gives us a buy signal, and it rises about 10 or 15 points. So you're doing really well in these first 2 trades here, and you get another signal to go short. So you decide to short the E-mini, and it doesn't go down, but it really doesn't go up that much either, so you decide to short some more since the lines are still crossing, and you decide that actually you shouldn't have shorted anything at all because the E-mini just goes higher and higher, and ultimately you've given everything back. It'll look familiar. And then lastly, you'll see the same scenario in the Forex currency pairs. In fact, you'll see it even worsely in the currency pairs because they trend better than any other market, in my opinion. For example, here's an older chart of the dollar-yen. Now, we are in the so-called overbought territory, so obviously you want to short. According to all of the rules and conventional wisdom which you've been taught before, you shouldn't be buying there, actually. You should be selling in anything that is overbought. So you decide to sell and go short the dollar-yen. And once again, it doesn't really go lower, but it doesn't go higher, so you double up. You decide, well, it's going to work this time, and I won't have to go that far for me to make all my money back. And it continues to go higher. So now you triple up because you're really committed now, and now you've got to make this money back. But it goes higher and higher, and pretty soon you've lost not only everything in your account, but anything else you've put in there to try and make up for the margin calls you're getting on trading these contracts here. So you see, there is no consistency in this type of trading, and I know firsthand because I used to trade this way. I would have 3 or 4 fantastic trades trading this way, and I thought I had it made. And then my 4th or 5th trade, I would give everything back, and I'd be right back at zero, even worse. And so I was struggling like this for months, close to over a year, when I finally figured that this isn't working. Everything I've been taught about trading overbought, oversold doesn't work. Why isn't it working? So if you recall, we said what is the right way to trade the tops and bottoms scenario, and this is what my mentors taught me. Once my mentors turned my way of thinking around, they said, Steve, you have to get this mindset. You change your mindset where things are overbought, oversold, because there is no such thing as overbought, oversold. Stocks, currency pairs, futures can go up as high as they want to, and they can go down to zero. We've seen stocks, everything that can and is able to go down to zero and go worthless, expire worthless. So there's no such thing as overbought, oversold. It's a recipe for disaster if you want to trade that way, because ultimately you may have a couple of good trades, but it's the next couple of ones that will give everything back. Remember, we're looking for consistency. Consistency is the name of the game in trading. It's not how much money you make, because trust me, I know tons of traders on the floor that made hundreds of thousands, if not millions of dollars, and they gave it all back. So it's not how much money you make. It's being able to trade 10, 20, 30 years down the road. And that's what we're looking for, consistency. When you're trading tops and bottoms, the way conventional wisdom tells us to trade, there is no consistency in that. So, what is the right way to trade tops and bottoms? I asked my mentors, I said, okay, if I shouldn't be trading that way, then how do I trade tops and bottoms? And their simple answer was to go with them. So what do we mean by going with the tops and bottoms? Well, here's the entry technique. Once again, this is not a system, this is not a strategy, this is just an entry technique. No stop placement, no exit point. This is just an entry technique that you can apply to any trading vehicle. All right, so let's look back at that older Apple chart. We have the slow stochastic plotted once again. So we want to trade overbought, oversold. But what is the correct way? Well, my mentors taught me that the first thing I had to do was apply one other indicator, and that was the 50-period simple moving average. Okay, so now we've applied the 50-period simple moving average. And so what are we going to do? Well, we have to ask ourselves, where is price in relation to the 50-period simple moving average? That's the first thing we have to ask ourselves. And look, where is price in relation with this Apple as opposed to the 50-period simple moving average? Price is below. So the rule is, if price is below, you will only look for shorting opportunities. This doesn't mean you're going to short at the market. It means you look for shorting setups. And it doesn't have to be one of my strategies or techniques in which I'm going to even be teaching you today. It can be any strategy or technique. But always ask yourself, where is price in relation to the 50-period simple moving average? So right off the bat, we know that we're not going to try and pick any bottoms with Apple. We're not even going to try and pick a bottom. We're only looking to short Apple. Why? Because it's below the 50-period simple moving average. All right, now we can go down to our overbought, so-called overbought, oversold tool, the slow stochastic. So since we're going short, we only want to look at the areas that are so-called oversold. Those are the areas where the indicator went below the oversold threshold. Remember, it doesn't have to be this indicator. It can be any indicator that has an overbought, oversold threshold. Since we're going short, we're only interested in the oversold thresholds. And once we have marked those off, then we look for the bottoms that were created when we were in the oversold area. Okay? Why? Because we want to exploit those short-term bottoms. If those short-term bottoms are violated to the downside, that's going to be our signal to enter. So as you can see here, a short-term bottom was created here in the oversold territory. There was another short-term bottom created here, as you see right here, but we were not in oversold territory. We were actually in overbought territory. So we're not concerned with that. There was another bottom created right here. It was not in the oversold territory. So we're not concerned with those. Only concerned with the bottoms, as we see here with the red horizontal line, that was created in a so-called oversold territory. We want to exploit that because that's where everyone thinks you should be looking to buy. And as we know, there's no consistency in that. So that's where you want to sell. And don't you think you could have done much better going short Apple here at these entry points? How about the E-mini example? Well, first thing we want to do is apply the 50-period simple moving average. Then we ask ourselves, where is price in relation to the 50-period? Obviously, price is above, right? So this means if price is above, we have no business thinking about shorting the E-mini. We're not even going to consider picking a top. We're only looking for buy situations, buy scenarios. Once again, it doesn't have to be this technique. It could be one of your strategies. It could be a system you follow. But if price is above the 50, regardless of what you're trading, you should only look to go long. All right, so if we're using this technique, we come to the so-called overbought, oversold tool, and now we want to look at the so-called overbought areas right here circled in green. Once we've found those, we want to find all the short-term tops that were created in the so-called overbought territory. All right, you see right here. And we want to exploit them. If they are traded one tick above, that's our point of entry. So you see, before trying to short the E-mini, based off of so-called overbought territory, we would have got killed. But now that we're exploiting that, now that we're going in sync with the overall trend because price is above the 50 period, we're exploiting that. Once those tops are traded and violated one tick above, we simply use that as an entry point to get in. Much easier to make money and much easier to be consistent in your trading this way. And then lastly, we look at that example, the older example in the dollar yen. Same thing, price was going up. We would have just literally lost a ton of money had we tried to short this. All we had to do that would have saved us so much money was apply a 50-period simple moving average. Ask yourselves before you trade anything, where is price in relation to that 50 period? Price is above, so we don't even consider shorting anything. You only look for buy scenarios. I know every once in a while we get students and members that say, Steve, I missed a great shorting opportunity because I didn't take it. It was above the 50-period simple moving average. And I always say the same thing. That's true. You're going to see a lot of them from time to time. But over time, if you're trading and you want to trade 10, 20, 30 years the way I am, this tool is going to be invaluable. It's going to be like gold because it's a numbers game. Sure, you'll have, every once in a while, you'll miss some great tops and bottoms. We're not looking for it to hit home runs. That's a losing mentality because it's just as easily to get killed as it is to hit a home run. We are looking for consistency. That's all we're looking for. 2 steps forward, 1 step back. We're looking to hit singles because that's what's going to sustain you. So, looking at this technique, if we're only going to be going long, then we only want to be concerned with the so-called overbought territory. All right? Right here, circled in green. And then we find the tops that were created in the so-called overbought territories. And we just exploit them. Once they're violated, 1 or 2 ticks to the upside, we simply buy. And look how easy it is to be in sync with the market as opposed to trying to pick a top. So you see, this is the correct way to trade tops and bottoms, to go with them, not to fight them, not to stand in front of a speeding train and hope that it stops. Because trust me, I know, I tried to go long in the crash of 1987, and you all know what happened then. So trust me, every once in a while it'll work, but the times it doesn't work, you really get your clothes handed to you. So let's look at some examples that have happened within the last couple of months and as recent as the last couple of weeks. Let's start out with stocks, okay? Let's look at this chart here of SNDK. This is going all the way up to the middle of July, just about 2 or 3 weeks ago. We see obviously that for a short time price was below the 50 period, but for the majority of this chart, price is above. And we have the same slow stochastic. We have not edited anything. We didn't go into the edit box and change anything. All we did was click on slow stochastic and the indicator came up. We don't even know what the rules or the parameters are, okay? So if we see here that we were below the 50-period simple moving average, actually right here, and we were in the so-called oversold territory. So there actually would have been a setup to go short, but only if price had turned around and gone back below. But it never did, so there was never any chance to go short looking back the last 2 or 3 months here. The only thing we could do was go long once price consistently closed above the 50 period. So if we're looking to go long, we obviously want to find the so-called overbought territories here in the oscillator. And then we find the so-called tops, the short-term tops that were created. And once they're violated, look all the chances you could have had to buy. You could have bought SNDK as early as roughly about 85 and made a quick 15, 20 points in the next couple of months. There's no strategy, no system, just showing you an entry technique. How about Coach, COH? Roughly the same time period, coming up to the end of July here, we are at this point, in the beginning of May, we crossed convincingly below the 50-period simple moving average. So what does this tell us? This tells us we are not in any way going to be buying Coach. We are only looking for a type of shorting opportunity. All right, so using this technique, we find the so-called oversold areas, and then we simply want to find the bottoms that were created in that so-called oversold area, and that's where you would have gotten short. See how simple this is? We are in no way trying to fight anything. We're not listening or interested in any news events. We're not concerned with any trading or chat room or what someone is saying on TV. All of these outside sources are the same things I used to listen to. And after a year of being a specialist, I had nothing to show for it. I had no gains. I was really worried whether my career was going to last that much longer because I couldn't make a dime. But I was doing what everyone was supposed to do. I was listening to news. I was waiting for all the earnings reports and all the events that were supposed to come out about jobless claims and all of that stuff. I was looking at every technical indicator you could think of, like 20 or 30 on my screen. And I was subscribing to newsletters. We didn't have trading rooms or chat rooms at the time, but we had newsletters. And I still couldn't make a dime, so why wasn't it working? I was doing all the things that conventional wisdom says you're supposed to do. My mentor said, Steve, strip away all those things. Don't use them at all. If you have to use them, just use maybe about 5% of your trading plan. Give that, your trading plan 5% interest in that. But that's about it. You should keep it as simple as possible and just listen to the most important thing. And what is that? That's the chart in front of you. Okay? That's all you have to do. If the market is below the 50, it's telling you, forget about the news, forget about indicators, forget about anything. Most likely we're going lower. That's all you need to know. So start looking for shorting setups. How about Alcoa AA? As we see here, obviously we're only going to be looking to buy this. Why? Because it's above the 50 period simple moving average. So it's above the 50. We just want to look at the so-called overbought scenarios all the way up till the end of July. And so all you had to do was find the short-term tops that were created once we were in the overbought area, and just simply go long once they were violated to the upside. CMG, obviously some news came out here in the middle or end of July where the stock gapped up, went up about 50 or 60 points. We don't care what the news was. We don't really care fundamentally what's going on in the company. All we know is that at the end of May, we closed for 2 or 3 consecutive closes above the 50. So this tells us we're only looking to go long now. That's the only thing we're concerned about. We don't care about what's going on fundamentally, what's going on in the world or with interest rates or with jobless claims. The market is telling us, this chart is telling us you should be long CMG. That's it. So we look at the overbought oversold tool. We find the tops that were created. And you could have gotten long as early as 560. Now we realize that that's a very expensive stock to buy, but you could have purchased options if you want. You could have got some long calls at 560 and made a good 100 or so points along the way. Or even you could have purchased odd lots in this particular stock. How about the E-mini? Let's look at some recent trades in that. Here's a 1,000 tick bar chart. For the E-mini, we'll see that this technique works just as well on intraday bars. So we're looking at an intraday bar, 1,000 tick bar chart of the E-mini just a couple of weeks ago. Price is above the 50 period simple moving average, so we only want to go long. We look at the so-called overbought areas of the slow stochastic and look at all our short-term tops that were created there. So you could simply purchase at these points. You could have made a quick 10 points if you just taken the first signal and ridden it all the way up. Now, we found that for the E-mini trades, this works great on smaller tick frames. So if you want to use this, you can work on a 5-minute time frame and 1-minute time frame. Tick bars, it works great as well. Here's a 1,000 tick bar chart just a couple of weeks ago as well, the E-mini. Obviously, we are below the 50, so we're only looking to go short in this scenario. All right, so we look at the so-called oversold territory. We find the bottoms that were created, and once they are violated by 1 tick, that's your shorting entry. Remember, this is just an entry technique. I know a lot of you are saying, well, where would I exit? Where would I place my stop? That comes in our courses, that comes in our mentoring, in our teaching, in all of our courses. This is just an entry technique which we're sharing with you today. Here's a 5-minute chart from the 4th. As you see here, this was the close on the 5th of August, right down here as you can see. So this was just last Monday, a week ago last Monday. We cross above the 50 period moving average around 9:30 Pacific time. So we're looking to go long. So that means we look at our overbought scenarios right here, our so-called overbought scenarios, and then we find all the short-term tops that were created, and simply you could have gone long there. You could have taken the first signals to entry roughly around 124, 125, and you could have had a nice 7 or 8 points to the upside in the next couple of hours. And then here's an example, another tick bar chart. This was yesterday, as you can see here. This was the close at 8:11, coming into the day of 8:12, which is today. We see here that the last 2 or 3 hours of the day, we were below the 50 period simple moving average, so we're looking for oversold scenarios. Here was one overbought scenario, but we never went above it, so there was no trade to the upside. So we just looked for areas to go short, and you could have taken advantage. This was yesterday, the last hour of yesterday. And the Forex markets. We know a lot of people like to trade longer time frames in the Forex market, so here is a weekly chart of the British pound. Now, the British pound, excuse me, for the past couple of years has been going straight up. In September of 2013, it consistently closed above the 50-period simple moving average. So this means we were only going to be looking to go long the British pound the last couple of years on a weekly basis. There's no way you would have considered shorting the British pound, and it's a good thing you didn't try to pick a top because you really would have lost a lot of money. Much easier to be in sync with the 50-period simple moving average. I've already showed you this really powerful technique on a tick chart. I've showed it to you on a daily charts. I've showed it to you on 5-minute charts and now on weekly charts. We showed it to you in any market, in any time frame, and in any direction. So do you see how powerful just the 50-period moving average is? It's such a great technique that works in any market, any time frame. So since we went above the 50-period here in September of 2013, we're looking to go long. These are the so-called overbought territories. We want to exploit them with the so-called short-term tops. And so those are your entry points. You could have been long this entire time in the British pound if you trade the foreign currency pairs. So, two very important points to remember. This is what my mentors taught me some 30 years ago. This is what got me on the road to consistency, and this is what I teach all of my students at Specialist Trading. Firstly, you must get this set in your head. You must get this mindset. There is no such thing as overbought or oversold. I know you're going to go to a lot of other webinars. You're going to read books. You're going to see people on TV that tell you this so-called currency or this so-called stock or future is overbought or oversold. Don't listen to them. From time to time it may work, excuse me, but over time it's a recipe for disaster to look at things as if they're overbought or oversold. It just won't work. There's no consistency to that type of trading. So don't look at anything in terms of being overbought and oversold. What you want to do is exploit it so you never ever try to pick tops and bottoms. What you want to do is simply go with them. So if everyone is saying this is a top, we'll wait for that top to be violated, and that's your entry point. So I gave you some great techniques here. Remember, I didn't give you a strategy. I know that's probably going to be the first question I get when we open up the questions excuse me, at the end of the day here. But in order to have a full-fledged strategy, you need rules for not only entry, you also need rules for exit. You need rules of where to place your stop. You need money management rules. You need rules of how many shares or how many contracts to trade. What we gave you here was a great technique for entry. You can apply this to anything. If you already have a strategy that trades tops and bottoms, use this technique. Apply this technique. If you want to build a strategy based off this, feel free to. It's a great starting point. It's one very important piece of the puzzle. So ask yourself, do you think that technique could have helped you? What about the 50-period simple moving average? I've often told this to my students. If I were stranded on a desert island, there were only one technique I could trade with, one indicator, it would be the 50-period simple moving average. Because that technique alone has saved me so many hundreds of thousands of dollars in the past 30 years. So ask yourself, do you think any one of these edges, do you think this edge could have helped your trading this past year? Go back and look at your last 10, your last 20 trades and see if you would have been in sync with the 50, or see if trading tops and bottoms hasn't worked for you. What if you would have applied this entry technique? Could it have helped? Excuse me. If I just take the last couple of seconds here, I want to tell you about a great offer we have for all the attendees today. This is a great presentation. It was actually a recording of a seminar that I was asked to speak at in Denver a little over a year ago. And we recorded this. It's really high quality video of 3 hours of more edges, of more learning techniques and tools. And we also included a full-fledged strategy with all the rules for entry, all the rules for stop placement, and all the rules for exit points. It's a great strategy. We call it strategy number 1. In fact, let me show you some of the current signals and trades in this particular strategy. Whereas the last technique we showed you was for trading tops and bottoms, this is more of a pullback technique. These are actual signals generated using strategy number 1, and all of our strategy number 1 course members would have been alerted to a buy signal on the 25th of June in Apple, as you see here. Do you see how this technique is a lot different from what we shared with you? Now we're looking to purchase on pullback. So we're not trying to pick bottoms. We're looking to pick bottoms within a trend. That's what a pullback is. Because once the pullback has concluded, the trend usually resumes in its original direction. So this is a great pullback technique. Not only works in daily bars, it also works in weekly bars. These are all weekly signals to go long Apple buy signals, as you see here, how they caught the bottom of these sell-offs, these small little pullbacks. Here are two current signals in Boeing to go short because it also works on the downside. The strategy predicted that we were in an overall downtrend, so it looked for pullbacks to the upside. In this case, we had a bounce. It generated a sell signal on this bar, and look, you had a small carry through, but then another signal was generated just a few weeks ago in July to go short, and then that one really carried through. Here's Facebook. Just about a month or so ago, Facebook was kind of drifting sideways, then headed lower. A lot of people thought Facebook was just going to sell off, but our proprietary strategy said that no, we're still in an uptrend and that it was just looking for some type of a bottom and a pullback. It generated a buy signal here, and then Facebook went up for the next couple of weeks. This also works in the E-mini. These are actual signals that were generated on a daily bar. Also, we've seen here that we are at a full uptrend in the E-mini going up until the end of July, and these were all buy signals generated using strategy number 1. But you can also use them intraday. Here's a 10-minute chart just from the last couple of weeks ago. On a 10-minute time frame, we see here that we had a really nice sell-off, and we got short just about at the top here on this signal bar. And you could have ended here the last day of July, and then the first day of August, another signal to go short in the first hour of trading, and look what continued. So this is a great strategy. We're going to give you all the rules to this, and you see it works not only in the E-mini, it works in the stock market, it works in the euro dollar. It's a great pullback technique, so it's totally different from what we just shared with you. So now you have a great entry technique for trading tops and bottoms. Becoming a member with the Strategy 1 course, now you will have a great pullback technique. As you see, it worked here on the weekly euro dollars. This is all included in the Secrets of a Stock Exchange Specialist training sessions. Once again, you get more high probability trading edges. We tell you which indicators to use and which ones not to use. We go into the definition between a system and a strategy. I share with you the #1 chart pattern you should always be looking for, how to be on the right side of the markets. In addition, once again, a complete strategy, all the rules to strategy number 1, which you can apply to any market in any time frame. And then lastly, you have access to my personal email address. Now this we sell on the site for roughly close to $1,000, but for all the attendees today, we've discounted it down to $37. So you get all of this, the full rules to the strategy with all of the different edges, such as the one I shared with you today. We have roughly a dozen more edges in this training session for only $37. So I really think you should take advantage of this limited offer. This is a great, great price. I'm sure it's probably less than many of you spend for commissions in one day, and you're getting all this free, great information. So if you're interested in stepping up to the next level for such a small price, contact the trading consultants at Pro Trader Strategies. They are our sister site, and they are the consultants who deal with marketing and promoting all of our individual strategies and techniques. That's the email address. If you want to speak to any one of our trading consultants, you can email them at trading@protraderstrategies.com, or you can call them directly at area code 310-598-6677. Now this, if you want to copy this down, this is the actual link that you can copy down on your browser, and this will take you to the $37 offer. Remember, that offer is only good for the next couple of days or so. So if you're interested, it's for a limited time only. If you look over on your right part of your screen in the little box there, you'll also see that it is in the chat box as well. So you can click that link on, and it's live, and you can go to the actual place and sign up for the $37 deal. Okay? I want to thank you all for waiting. I'm sure you have a lot of questions, so let me just open up the question and answer box. And let me ask Robert here. Robert asks, what dates does the 50-period simple moving average start and end on? Well, it depends on how many look-back days you want to have on your charts. I usually have my charts set up to at least looking back 30 to 50 days, you know, a good 3 to 6 months. So it's up to you. But I would look back at least 3 or 6 months. Now, if you're looking at intrabar charts that just go down to that many days, in other words, look back, or intraday time frames, I should say. But what you want are 30 to 60 plots at least plotted to have a 50-period simple moving average. When I'm talking about plots, I mean days, actual days. Because the 50-period simple moving average, if you're looking at an intraday bar, a 5-minute bar, it's going to take each 5 minutes, okay? So, and remember, there's nothing magical about that 50-period simple moving average. I know a lot of people always say, well, Steve, I like to look at a 20-period moving average, or I was always taught a 200-day moving average. It's been my experience and the way my mentors taught me, when you're trying to keep things as simple as possible, which is really our philosophy of specialist trading, you don't want to be mixing and matching different indicators for different issues, for different time frames, for different directions. You want to be keeping something the same and keep it simple so that you don't have to mix and match back and forth. So we've seen that the 50 works the best. You don't have to keep changing and varying the moving average with a currency pair as opposed to a 5-minute time frame. A 20-period moving average is great for smaller time frames, but it doesn't apply very well to looking at daily or weekly bars. And the same conventional wisdom says that a 200-day is very good for weekly bars, but it doesn't work very well if you're looking at a tick chart. So the 50 fits in well with all of those time frames. Once again, if I could only use one tool, it would be that, the 50-period or buy-sell line, which we call, okay? Joel says, when price rises up to the 50 on a 5-minute chart, it often stalls there. Sometimes rises, sometimes falls. Any other relevant indicators when price crosses the 50 period, or just wait till it is above the recent high? Well, Joel, that's a very good observation. Here's the rule of thumb. When we're using that 50-period tool, we usually want anywhere from 2 to 5 consecutive closes above or below that 50 to tell us what side to be on. So if we have one close above the 50 period, that does not say, well, I guess I can only look for buy setups now. No, we need anywhere from 2 to 5 consecutive closes above there, all right, in a row, in other words. As many times as you just stated, we'll close above there, and then we'll come right back down. Now, we have another great tool, but I'm not trying to in any way promote that right now, but since you asked, you may want to talk to our trading consultants. It's called the PET-D, which is great for trading off of that 50-period simple moving average. We have another great strategy called strategy number 4. But I really don't want to go into that because I'm really trying to get you just to, I don't want you to spend more money than you have to. $37 is a great technique, and strategy number 1 is great. But if you're interested, if you're a more advanced trader, ask about strategy number 4, the PET-D. That's a great combo that uses that 50-period simple moving average, okay? Which broker do we use? Well, we don't have any affiliations with any brokers. We don't have any, all brokers are fine. We always suggest try and get the broker that has the smallest commission because you're making your own decisions yourself. We don't want you to pay for anything that you don't have to. So in other words, why should you pay for some broker who, will give you advice or really, will tell you that these are the markets you should be trading when our philosophy is we teach you sound education so that you can empower yourself. You don't have to rely on anyone to make trading decisions for you. So all we always suggest is to get a discount broker. That's what we use. Okay. Jillian asks, can you repeat again what the settings are for the oscillator, the stochastics? Well, yes, Jillian. Actually, I can't repeat what the settings are because I don't know what the settings are. It was a slow stochastic, though, just your standard slow stochastic. And the only settings I can give you, the overbought threshold is usually set to 80. So that line, that horizontal line, where when the indicator's crossed above it, that's your so-called overbought area, that is 80, anything 80 or above. The so-called oversold threshold, where anything below this threshold is oversold, is usually set to 20. But in terms of the default settings, how many lookbacks you're looking at or what the indicator is actually based off of, I don't know. I'm not interested in that. Once again, I don't want to complicate my trading by trying to figure that out. So another thing I stated earlier, it's not like this indicator I was using is so magical. You could apply this with any overbought, oversold oscillator. It doesn't really matter. All we're looking for is to exploit when the majority of traders are using the conventional wisdom telling them that, well, we're in overbought, we've got to go short now, or now we're in oversold, we've got to go long. And then we create these so-called overbought, oversold situations. We just want to exploit them when the tops are violated or the bottoms are violated. That's all we're trying to do. So it doesn't really matter which tool we're using, which indicator. A lot of people even like to use their own indicators that they've come up with that are overbought, oversold, and they just use those to exploit. Okay? Jay asks, do you have a signal service for picking tops and bottoms, or do you have to find them on your own using the video courses? Well, once again, Jay, I don't know if you were in the beginning here of the presentation, but I said it's not our philosophy to force feed any of our members signals. I think that is the quickest and fastest way to losing money in the markets. I mean, think of it. If we have all these sites, all these people on TV, all of these educators telling you you should buy here, you should sell here, and we don't have any more consistent traders. So in my opinion, the reason is because you're giving your power away. You're not empowering yourself. You're not making your own trading decisions. So even though we provide our members with strategies and we tell them when certain signals have generated, buy or sell signals, we're not telling you you have to take those. We're just showing you those for educational purposes so that ultimately you know how to spot them on your own, so that you can check your homework and say, oh, that's great, I got a sell signal too. So now I don't have to rely on these guys anymore. I can just go trade on my own. That's what we want you to do. We want you to take all this information in our courses, and even though you're a lifelong member, you don't have to be waiting and hoping and praying on every signal that we post on a nightly basis. We want you to go out and get them for yourself. So that's what we do. It goes against everyone's best interest, I think, by telling you where tops and bottoms are and telling you where to do that. We really want to teach you how to spot them, and it's really simple. And we give you the tools and tips and techniques, and once we teach you, it's really easy to spot them on your own. Okay? Let's see here. Hemeth is asking, our student from India. He says, hello, sir. How are you? We're fine, Hemeth. If strategy 1 is supported for PET D, yes, you can. What he's asking is a totally another tool we have, which we're really not talking about today. But strategy number, any of our strategies can use another tool we have, which is called the PET D. It's a short-term trend identifier. So it doesn't matter what you trade. Any of our strategies or one of yours, you can always use the PET D to help enhance that. Okay? Kent says, I got in here late. Did you give the numbers for the stochastic? If you just heard Kent, I just used a standard slow stochastic, but it really doesn't matter. Okay? Let's see. Jay says, what do you call today's strategy? Is there a strategy number? When you say today's strategy, well, are you talking about, Jay, what I shared with you today was just an entry technique. It's not a full-fledged strategy. In order to be a strategy, you need to have an exit point. You need to have a stop placement. You need to have rules for money management. And we supply that with all of our strategies. We have upwards of 10 strategies for all the different markets. But what I gave you today was just an entry technique, so it's not a real strategy. It's just our top and bottom entry technique, okay? Dave asks, does the software include arrows, flags, values to identify stops and take profit points? Dave, the strategy, all of our strategies provide add-ons, but we only provide add-ons where the setup bar is, where the strategy is telling you to enter. Because, once again, we are an educational company, we show you a ton of different ways to enter. We show you different exit points, and we show you different stop placement points. Why? Because everyone trades differently. So we try to fine-tune a strategy to meet your needs. Even though the basic core of the strategy stays intact, all of the different things can be changed because this is how you become a part of the process. This is what we teach you. It's my opinion that no two people can trade the same way. If they try to, only one's going to make money. The other one is going to lose because everyone has a different trading personality. You know, someone may say, well, I couldn't enter into that trade. It was too risky. Well, you may want to use this stop then. Okay, well, that's totally different from trader number one's stop placement. So that's why we don't give exit points or entry points and things like that. We just tell you where the setup is, and then through the course material and through my mentoring with you in correspondence, you know how to enter that best suits your needs and what makes you feel comfortable, okay? I always give this example in webinars. I once mentored a student before I started specialist trading. This was when I was just managing money, and I sat with him for roughly a week or two, and I taught him the strategy I was currently trading intraday, and I taught him all the rules, all the exit points, everything that I used for my trading, okay? And by the end of the 2 weeks, he knew exactly where to enter, where to exit, where to get out of the markets, and we stayed in correspondence for a while, and then I lost contact with him. Well, there was a particular time frame where the strategy was just phenomenal. Everything was working, and you would have made a lot of money. So I called him up and asked him how he was doing. He must have done really well because I did very well. And he said, no, he actually lost money. I said, how could you lose money if you're doing, did you get the same entry point? Yes, same exit point. I said, well, what happened? He says, well, I couldn't follow the rules. I said, why couldn't you? He said, because I was too scared to pull the trigger. Sometimes the risk was too small, sometimes it was too great. I wasn't sure about the exit point. I didn't feel like the market was going to go in that direction. I lost my confidence, so I kept entering at different points, different exits. So in other words, he couldn't follow the same thing. And it turns out that everyone has a different trading persona. Two people can't trade the same way. He was a much more conservative trader than I am. Now, when I was on the floor, I was much more conservative than 90% of the other traders. So it's all relative. So no one can trade the same way. You've got to find something that works, some basic framework, and then mold it to suit your needs. And that's what we do at Specialist Trading. Okay? We don't tell everyone to trade the exact same way. Once again, in our opinion, that's a recipe for disaster. That's why we don't have chat rooms. That's why we don't want our people to depend on signals that come out every day. We want you to become a part of the process. Okay? I hope that answers your question. Let's see, next question here. Pullbacks are a good way to trade. Well, yes, the majority of what we do is trading through pullbacks or through consolidation. So another way of that, if today you wanted to look at it today was basically consolidation trading. We would wait for some type of consolidation and then enter once the trend resumed. But yes, everything we do at Specialist Trading is based off of a two-part process. We look for the trend, and we use our proprietary tools to discern what the trend is, and then we look to buy within that trend, either through consolidation or pullbacks. And that's it. We keep it simple. We never try to pick tops. We never try to pick bottoms. And from time to time, it'll look like we're picking a top or a bottom, but all we're doing is buying on a pullback within the trend. Okay? I showed you some great examples with strategy number one, how you could really buy these bottoms in stocks and in futures and the currency pairs, and it looked like we were bottom fishing, but we really weren't. All we were doing was buying pullbacks within the trend. That's how great strategy number one is. It's a great pullback strategy, works in any time frame, in any direction. So if you really want to take your trading to the next level with a great strategy that our members have paid upwards of $1,000 for, and along with that you get over a dozen trading tips and techniques, I strongly urge you to take advantage of the $37 deal. It's only going to last for a couple of days, and we're going to move on to something else. But this is a great deal, great information. It's a 3-hour video that's yours for life. A lot of people are always concerned with, well, Steve, is this video only good for a couple of weeks, then it kind of just dissolves and I lose contact? No, it's yours for life. It's an online video that you can access whenever you'd like. Okay? You get all the rules and everything. As well, you can access me whenever you'd like. You're going to get my email address as well. Okay? So once again, here's the information you need if you want to become a part of our family. Please take advantage of this really super low introductory price, and then you can decide whether you want to step up and get some of our other really consistent strategies and trading techniques. Thank you so much. Thank you so much for joining us today. We really appreciate you coming in the middle of August to come see one of our presentations. Here's the information. Once again, contact our trading consultants at trading@protraderstrategies.com or call them directly at area code 310-598-6677. Here's the link. You can copy this down or simply go to your chat box on the right and click on that 37 offer as well. Thank you so much. We'll see you next time. I look forward to all of you becoming members of Specialist Trading. Bye-bye.